Hello, my friends. Today is October 7th. My name is Joseph, and this is Markets Weekly. This week, we're going to talk about three things. First, we're going to talk about how the Fed really seems to have pulled off a soft landing. Secondly, let's talk a little bit about what's happening in Japan, where many market participants seem to think that maybe the Japanese authorities intervened in the market the past week to support the Japanese yen. And lastly, let's talk a bit about crude oil. Now, crude oil has been on a tear, and it seemed like it was going to breach $100, but then it tumbled bigly this week by almost 10%. Okay, starting with the soft landing. Well, first off, let's talk about just what a soft landing is. So, if you rewind back to what was happening the past 2 years, inflation was high and the Fed was raising rates. Now, Chair Powell had a memorable performance at Jackson Hole where he basically told everyone he's going to hike rates and there will be some pain.
Higher interest rates, slower growth, and softer labor market conditions will bring down inflation. They will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation.
Now, according to traditional economic theory, the way that you get inflation under control is you hike rates a lot, you slow the economy down. In the process, unemployment increases, but because there's less demand in the economy, inflation falls. So that was the playbook. And that's really what the Fed was trying to get at. They keep saying over and over again that they were looking for the unemployment rate to go higher because they were operating under that mental model. Now, many people over the past year have been telling the Fed to stop hiking rates because, hey, inflation really is slowing down. Now, people could point to goods inflation, which is definitely slowing, or they could point to shelter, which is rent, which is definitely by many models and by actual rents appears to be slowing. But despite all that data, the Fed was really persistent about continuing to hike rates. In fact, they invented this new measure called core services x housing, which basically focused on all services excluding housing and said that, well, this inflation here, it's still humming along above 4%. And so we got to keep hiking because this stuff, it's really sticky. Now, this past week, we had the non-farm payroll data. Now, the non-farm payrolls data this week was unambiguously very, very good. It was excellent. So job growth the past month was 330,000, which was about double expectations. Now, I know many people in social media would look at this and try to pick at this, pick at that, talk about adjustments and so forth. But listen, those guys have been saying the same thing for over a year and they've been totally wrong all the way. And I'm beginning to think that they're never going to get it. Now, the jobs report is strong. And it's strong in two ways. It's not just the number of jobs created, but it's also that wage growth slowed down. So wage growth, basically what the Fed has been focusing on, what the Fed has been trying to get to, thinking that the only way they could get wage growth to slow down was through unemployment. Well, they were wrong. Apparently, wage growth is slowing and the economy continues to create jobs. That is basically the mythical soft landing. The economy continues to grow, inflation continues to fall. There doesn't seem to be any economic distress. Now, with this soft landing in motion, now that really tells the Fed that they probably don't need to hike anymore. Because the thing that they were afraid of the most, the last thing that they were focusing on, core services X housing, well, with wages coming down, that's pretty much going to slow down significantly going forward as well. So I know initially that I had told everyone that I thought the Fed would hike one more time this year in accordance with their dot plot. But based on this new information, I'm beginning to think that they are done for the year. And not just because of that. Notice that the 10-year yield, so longer dated interest rates, have continued to rise. They've risen significantly over the past few years. Now that's going to have a pretty market slowing effect on the economy because when the Fed adjusts the overnight rate, say raising the Fed funds rate up or down a little bit, that doesn't really matter because no one really borrows at the overnight rate. But when you're pushing the 10-year yield up, well, that really does affect economic activity. So in effect, even though the Fed has done nothing the past couple weeks, in effect, financial conditions have tightened. So I think that as things are, I'm guessing the Fed is done here. Now, it doesn't mean that really the inflation battle is definitively over. We still have a couple of things to look out for. One, of course, is there's always the prospect of a rise again in commodity prices. And secondly, economic growth, in theory, should also push up inflation. Now, we don't see that happening, but in theory, as as economy continues to grow, you can see demand coming back, and again, potentially inflation reaccelerating later on. Uh, Keeping in mind that the deficit continues to be very large and supportive of growth. But those are things to keep an eye on in the coming months. At the moment, though, I think things look really good. Now, secondly, let's talk about what's going on with Japan. So let's just level set for a moment. So Japan, of course, we all know them as a country that had many years of low inflation and sometimes deflation. So as inflation swept across the world, central banks throughout the developed world raised rates aggressively. Fed, ECB, Bank of England, and so forth. Japan, even though inflation in Japan has also risen and is comfortably above their target and has been for some time, the Bank of Japan has steadfastly refused to raise rates. In fact, at the moment, they are still in a negative interest rate regime. What they did do, though, was they did slightly adjust their yield curve control target for their 10-year JGBs so that it was wider. So in the beginning, they were saying the 10-year JGB yield cannot go above 50 basis points. And then a few months ago, they widened it, allowing it to go as high as 1%. Now, that was one adjustment that they made. Now, this so far has been causing problems with the Japanese currency because as everyone else's interest rates have risen, you can understand that many people in Japan, well, maybe they don't want to have negative interest rates, so they would rather move their money to the US, for example, where you could get 5% interest rates at a money market fund since the Fed has hiked rates so much. So over the past several months, we've seen significant depreciation of the yen. The Bank of Japan has basically so far tried to stop this sometimes by intervening, but it really hasn't been effective. And so over the past few weeks, as the 10-year yield in the US has steadily risen, and as the Fed has telegraphed the prospect of at least higher for longer, well, the yen has steadily depreciated. And this past week, it breached a key psychological barrier, the 150 yen barrier. Now, upon breaching that, it immediately slapped back and strengthened significantly. Now, rumor was that that was the red line that the Bank of Japan was watching. Okay, so technically it's the Ministry of Finance that does intervention, that makes a call. So anyway, the Japanese authorities saw that and they intervened. Strangely enough, there's also many reports afterwards suggesting that they did not intervene, and also note that the yen promptly weakened again, not too long after that shock. So it seems that what we're looking at right now is that the market is really nervous about the yen. They know that, obviously selling the yen has been a winning trade, but they also know that there is some kind of red line somewhere where if they cross it, the Japanese authorities would jump in and intervene. It could be that this enough is going to keep the 115 line at least as a soft ceiling for now, since everyone is scared that the moment they cross that, the Japanese authorities would jump in and then they'll have big losses. But at the end of the day, though, no matter how much they intervene, it's never going to be enough because the interest rate differentials are too large, and the Japanese authorities know that as well. So right now, the whisper is that sometime next year, maybe the first half of next year, they're going to actually exit their negative interest rate policy and maybe potentially even get rid of yield curve control. Basically, they're going to move towards normalizing policy. A bit late compared to everyone else, but they're going to get there. And that way of basically normalizing policy is really the only way that they can sustainably make sure the yen does not depreciate uncontrollably. Now, this again is going to pose some challenges to many people in Japan as well, because Japan has had zero or negative interest rates for a very long time. And you can imagine that there are probably a lot of people holding JGBs. Now, can't make it Japan holds a ton of them, but you can also think of other maybe financial sector entities like banks and insurance companies holding them that they might have significant mark-to-market losses. So it's going to be an interesting experiment, but it's something that I think they can handle, and they definitely seem to be doing it slowly. Now, note that in the past few weeks, as the JGB yields rose, the Bank of Japan was always in there buying to make sure things were orderly. I don't think they were pushing against the level in so much as making sure that this was going to be an orderly move higher. And so far, it looks like they've been doing this successfully. Okay, now let's go to our last topic, oil. So over the past few weeks, basically beginning with Saudi Arabia's strong suggestion that they were going to adjust their output in order to, I guess, put a floor on oil prices. Oil has been well supported and has surged higher. Now, it all seemed like oil was really inevitably going to reach $100. There seemed to be a lot of momentum behind it. But this week, suddenly, it tumbled. Oil tumbled about almost 10%. And it happened pretty suddenly. Now, again, when you look at market moves like that, it's always hard to know what was behind it. And so people tell stories. Now, I think there's a couple popular stories here that I think make sense to me, so I'll share. Well, first of all, it seems like global demand maybe is weaker than expected. One data point for this is gasoline inventories in the US. It seems like gasoline inventories were higher than expected, suggesting that there's less demand for gasoline, which in turn could suggest less demand for oil. And related to this, though, there's also some thought that maybe global demand for oil is slowing in part due to rising interest rates. So as the US 10-year yield goes higher, that actually has global impacts. So sovereign bonds throughout the world are strongly connected. So when you have a major market like the US Treasury market, yields going higher, that's pushing up global yields in the Eurozone, in Japan, everywhere in the world. In a sense, it's like a global tightening of financial conditions. And the thing is, while the US economy is pretty strong right now, that's not the case in many other parts of the world. We've heard many times that Germany, for example, doesn't seem so great. And we also see, let's say the economy in China doesn't seem all that great too. So as global financial conditions are tightening, that could push some countries into a recession, and which would obviously suggest lower oil demand. Now, closely related to this is that as US yields have gone up, the dollar has strengthened significantly. Now, oil is priced in dollars. So as we look at oil, let's say $80 is $80, $90 is $90. If you're someone, say in Japan, you're looking at it in terms of yen. So when oil prices go higher and your currency is depreciating, well, you are hit with a double shock here. In yen terms, in foreign currency terms, oil is becoming a lot more expensive. And that, I think, is potentially reaching a point where we have some demand destruction. Now, one other thing I'll note is that a lot of the people who play in the oil market, they are trend followers, CTAs. So a CTA's business model is basically momentum. So they buy what's going up and they sell what's going down. And so when you have something like oil, which has basically gone straight up for the past few weeks, I can imagine that there's a lot of people there who are there just following the trend. And these moves can be volatile. You can maybe get too much leverage, become very nervous, and at the slightest hint of some potential distress, you could get out to try to save your profits, and you could have the whole thing tumble down. Now, going forward, I have no idea what oil prices will be. I think I'll leave that to other people. There are good stories saying that we could have geopolitical risk and so forth. So we'll see. But that, I think, remains another potential upside risk for inflation going forward. Commodity prices could again reaccelerate, notwithstanding what, in retrospect, this week could just be a correction. Okay, so that's all I've prepared for today. Now, if you like what I'm producing, remember to like and subscribe. And if you're interested in hearing my most recent thoughts, check out my blog, fitguide.com. And if you're interested in learning more about how markets operate, check out my online courses at centralbanking101.com. Talk to you all next week.